REITs have a very broad menu of investment options. And with that, we're seeing a lot of investors are looking to REITs to really complement their existing portfolios. So it's just a great way to add diversification and even some return enhancement to an existing real estate portfolio.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. Joining me today is Ed Pierzak, Nareit's Senior Vice President for Research. Ed is with me to discuss key themes from Nareit's 2026 mid-year update. Ed, thanks for joining the podcast today.
Pleasure to be here, Sarah.
So, Ed, to get started, could you talk about broad REIT performance in 2026 in a historical context and what that might indicate going forward?
Sure. REITs really had a very good year in the first half of 2026. They outperformed the broad equity market, and this is really a reversal of a trend that we saw as of last year for a full year performance. And, I think it's interesting to compare 2025 and 2026 because in both instances, REITs had very strong performance early in the year through February. However, we had some unexpected shocks. So in 2025, we had the unexpected shock of the new tariff policies. 2026, we had the unexpected shock of the conflict with Iran. And in 2025, those tariff policies really derailed REIT performance. So they ended up underperforming the broad equity market. But when we take a look at 2026, REITs have maintained their outperformance. And then even when we take a look at a little bit of a longer historical context, we find that oftentimes when REITs outperform early in the year, they tend to best broad equity market performance through the remainder of the year. And again, that's barring any unexpected shocks.
And Ed, how have gains this year been distributed among the various REIT sectors? And can you compare 2026 to what we were seeing in 2025?
Yeah. So when we look across sectors, so REITs have 13 sectors, and 2025 performance was not particularly strong across all the sectors. Only 5 of the 13 had positive gains. But when we look at 2026, at least through mid-year, we end up seeing that all but 2 sectors posted positive gains. And when we take a look at some of the stronger performers and weaker performers in 2025, we had healthcare topping off the list. Again, we had some strong demographic tailwinds there. In addition to that, limited supply. And interestingly enough, despite the tech rally and persistent media coverage, data centers were actually the worst performing sector in 2025. But then when we move over to 2026, we see that data centers, in fact, are one of the top performing sectors. But taking the top spot this year, we end up having lodging and resorts. And this is really fueled by very strong leisure and business travel demand.
And turning to valuations, how do REITs compare to broader equities at this point?
We've talked about a divergence in actually 2 aspects. One, with REITs with the broad equity market and also public and private real estate. So when we take a look at the current situation, we've had a divergence between the broad equity market and REITs really since about late 2022. And this is something that's fairly uncommon. It hasn't happened a lot. And really the last few times it happened was the GFC and COVID. But when we've seen the tech rally has lost a little bit of steam here into 2026, and we've seen kind of a drop in the price to earnings multiples, and we've seen strong performance on REITs. So we see that gap closing. And ultimately, when we see those valuation multiples converge, that's a time that REITs often outperform.
And would you say that the valuation picture has changed on the public-private side?
Yeah, public and private real estate valuations, the divergence continues. We've really hit a record here. We're at 17 quarters. And when we take a look at the gap, it still stands at about 150 basis points. But interestingly, when we take a look at the appraisal cap rate on the private side, we see that it's kind of been stuck. And in fact, it's been stuck at a level now for almost 3 years. And if we just go back and compare that to a REIT implied cap rate, REITs had that equivalent cap rate at the end of 2021. So in some ways, you can argue that private real estate's been being priced as if it were 2021. In addition to that, we see that there's a very narrow margin between the REIT appraisal, or rather the private appraisal cap rate and the 10-year Treasury yield. And over the last 3 years, it's averaged just a little over 25 basis points. And when you do some comparisons, you have the gap between the REIT implied cap rate and 10-year Treasuries. That's at over 160 basis points. The spread for the highest rated bonds over the 10-year Treasury, corporate bonds, that's sitting at about 100 basis points. So we really think that this relationship that the private appraisal cap rate has is really untenable. And again, when we ultimately see this gap close, that's a time when we see REIT relative outperformance.
And Ed, what does the valuation divergence mean for REITs more broadly?
We have these divergences, and again, they happen from time to time, but really on two fronts. We're starting to see a convergence with the broad equity market. That typically leads to REIT relative outperformance. And then also, we are ultimately waiting for the convergence with public and private real estate. The one thing we do know about divergences is that when they happen, we've always, at least historically, had a convergence. So as we see that gap close, we would expect some outperformance for REITs as well.
So 2026 to date has been fairly active on the M&A front. What are the numbers indicating in terms of capital shifts within the industry?
There's been a lot of consolidation or acquisition activity, and that's both public and private markets. And when we take a closer look at that, oftentimes when we see the privatizations, the media tends to grab onto that. But a closer look at the data that we had thus far in 2026 really shows that the lion's share of transaction dollar volume has been a consolidation of public listed REITs. So right now that metric is at about more than 80%. And when you take a closer look at the privatizations, we see that those tend to be smaller deals. In addition to that, the private side is paying a higher premium. We look at this activity as healthy, and it's really an indicator that the market is working as it should.
And following on from that, what other trends are you seeing in terms of REITs accessing capital sources?
Yeah, so REITs have always had great access to both equity and debt. When we take a look at a lot of their usage, almost 50% to date has been in unsecured debt. And this in many ways gives REITs a competitive advantage. If you take a look at the average cost of that debt over time, in 25 and 26, that average for both years was about 5.3%. So very attractive financing rates. But also what we see is that REITs are really doing a lot of direct joint venture deals with institutional investors. In addition to that, they are starting investment management platforms. And so with that, we really see that REITs may have a much wider menu of capital sources than a lot of the private counterparts.
And Ed, putting all these various threads together, how are REITs positioned for the rest of 2026?
Well, I think you look across a lot of the factors. You look at REIT operational performance. It's been very strong. REITs have maintained disciplined balance sheets. In addition to that, when we take a look at the valuation dynamics, we have two opportunities for REIT relative outperformance there. And then also, really, REITs have access to durable capital. You combine all these things together, and I think that there's really strong momentum, not only for the remainder of 2026 and beyond. And one other thing is that, as I mentioned earlier, REITs have a very broad menu of investment options. And with that, we're seeing a lot of investors are looking to REITs to really complement their existing portfolios. So it's just a great way to add diversification and even some return enhancement to an existing real estate portfolio.
Ed, thanks so much for joining the podcast today.
Thanks, sir. Bye.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.